the traditional ways of investing don't seem to be as effective anymore. That's why over 500,000 people, just like you and me, have started looking at new options. One of those is art investment. In this video, we'll review a platform for art investing called Masterworks, where it allows you to buy parts of valuable art pieces like those by Andy Warhol or Claude Monet. It's been heavily promoted on YouTube, with many popular creators suggesting that investing in art is a smart move. They talk about impressive returns like 39% per year, which sounds amazing, but it also raises some doubts. Investing in art can be quite questionable, especially after seeing things like the ups and downs of NFTs. It's becoming quite a bit of a rule that if an influencer is promoting a great financial opportunity, it might not be trustworthy. That's why we're going to talk about Masterworks and figure out if it is a real opportunity or just a hype. There are significant risks when it comes to getting your money out, like some extra fees, and it might seem like they might be showcasing only the best return numbers. To be clear, technically they do mention these things in their official documents, so there are no illegal processes involved here. If you're thinking about using Masterworks, it's a good idea to watch this video first. So, what exactly is Masterworks? Let's start by knowing what Masterworks is and what the purpose is. Investing in art isn't a new concept. It's always been seen as a different way to invest because, unlike businesses, artworks don't generate regular income. But historically, art prices have gone up faster than inflation due to their collectible nature. Some art pieces have even delivered impressive returns over time, especially if the artist's reputation grows. However, art investing has mostly been for wealthy people because it's super expensive. Pieces from famous artists, even those still alive, often cost millions of dollars. Plus, buying and selling art can involve hefty commissions, sometimes as high as 20%. You also have to pay for things like storage, insurance, and when it's time to sell, finding a buyer for your specific piece can be a real challenge since many artworks are only sold once. So this is where Masterworks steps in. Masterworks claims to be the first platform where you can invest in art without breaking the bank. They say you can buy shares for as little as $20. Here's how it works. Masterworks buys valuable art, creates a company like a limited liability corporation or LLC to own and take care of the art, and then they ask the Securities Exchange Commission or SEC for permission to sell shares of that company to their members. So when you invest through Masterworks, you're actually buying shares in a company that exists solely to own and manage the artwork. In the future, maybe 3 to 10 years, Masterworks plans to sell art and share the money with the people who hold these shares. What's cool is that Masterworks has a secondary market where you can sell your shares to other Masterworks members before they sell the art. This can be handy if you need your money sooner. But of course, Masterworks doesn't do all this for free. They charge a 1.5 annual management fee and takes a 20% cut of your profit when they sell a painting. It might sound a lot, but it's similar to what hedge funds charge for managing investments in things like art. These fees cover all the stuff that makes dealing with art a hassle, like storage, appraisals, and insurance. What's a problem? So, what's the catch? Masterworks ads really make it sound like art is a great investment. They say things like art beats inflation and is a low-risk, diversifying asset. They even claim that it outperformed other investments. While there's some truth to these claims, there's a big downside, and that these ads usually don't mention that art is a super risky investment. Not a regulated investment. First off, art, like cryptocurrencies, isn't regulated as an investment. Even though Masterworks acts like an investment platform, they're not registered as a broker-dealer or any other kind of investment firm with the SEC. This means that you don't have the same protections as you would with a traditional finance company. Sure, Masterworks partners with SEC-registered firms to run their secondary market and offer advice, but they themselves don't face the same level of oversight, reporting rules, or strict standards for showing returns as regular financial companies. Even the shares of the LLCs they create are filed with the SEC using an exception called Regulation A, which means that they skip a lot of the auditing and reporting required for normal share offerings. This doesn't mean Masterworks is necessarily trying to cheat investors, but it does mean you need to be careful. There's way less oversight compared to traditional brokers, and none of the safety nets or insurance that will protect your money if Masterworks hits hard times. Uncertain investment. Another thing to consider is that buying art as an investment is pretty uncertain. The value of art depends on what the collector likes, and that can change over time. A report from 2018 found that over 118 years, fine art didn't do well as global stocks or most other collectibles. Also, according to Masterworks' own SEC filings, art is hard to sell. Lots of art pieces don't find buyers when they're put up for auction. This means that art investors might have trouble finding someone to buy their art. Even though Masterworks has a secondary market, it doesn't seem very helpful. In fact, as Masterworks themselves say, you should be ready to hold onto your shares for a long time because there's no guarantee you'll be able to sell them. So, despite those tempting returns you see in YouTube ads, you're taking on a lot more risk than you might think. To be fair, Masterworks does try to address some of these issues. They manage to reduce the big fees you usually pay when buying or selling art. They get a lot of their compensation from shares in the artwork and a cut for the profit when they sell it, so they have a reason to make sure that the art sells eventually. And yes, while there are risks, the potential rewards are attractive. Contemporary art, which is what Masterworks focuses on, has outperformed many other categories. Inaccurate index return numbers. However, there's a problem with those index return numbers. While they might look great for contemporary art, you should be cautious about trusting them entirely. These numbers come from indices created by Masterworks, but they all have their limitations. The art market is pretty secretive, with no central database to track prices and performance. So, these indices rely on data from repeat sales of artworks that auction houses are willing to share, and that's only a small part of the art market. One study found that only 2.5% of auction sales from 1960 to 2013 were identifiable repeat sales. Also, there's a bias in these numbers because artworks that lose value might not show up in the data. People often hold on to art for reasons other than investment, like personal enjoyment or status. In fact, most collectors buy art primarily for non-investment reasons. Only a small percentage buy art purely as investment. Even among ultra-wealthy individuals, collectibles like art make up only a tiny part of their assets. So, even if these indices accurately reflected the performance of all artworks, it might not be that relevant to your experience because art is so unique and personal. Plus, with Masterworks, you're the one picking the individual pieces you want to own. Past performance doesn't guarantee future results, especially when it comes to someone else's artwork. But you might wonder about Masterworks' track record, as they claim an average annualized return of around 25%. Does that mean they're great at picking art? Attractive or biased track record? Despite all the points stated, Masterworks does seem to have an attractive track record, with returns ranging from around 9% to almost 40% per year, which is pretty good. But you might notice that this track record only includes 11 paintings, even though Masterworks claims to have over 200 assets. This makes sense because they only started their platform in 2019, and the old paintings were 3 to 10 years. But it's not a very representative sample. But here's a catch. While Masterworks often talks about these 11 figures, they also have a return figure for their entire art portfolio based on their internal appraisals, and that's 9.9% per year. It's not bad, but it's a long way from the average 25% annual return they show in their track record. There's also a potential bias in this track record because every painting in the list was sold before Masterworks' stated 3 to 10 year holding period. That raises questions about whether Masterworks might be cherry-picking the winners to make their track record look better, while keeping the losers in their portfolio. The true-up. The most concerning thing here is an extra cost that many people don't know about, which is the true-up. So, what's the deal with the true-up? On Masterworks' website, they talk about their 1.5% management fee and a 20% profit share, but there's also this bit about additional expenses associated with acquiring, sourcing, securitizing, and selling the painting that are paid by the issuer. That might sound a bit confusing, but the issuer here means the LLC that holds the artwork, and in simple terms, it means these extra costs will end up being paid by the investors. Now, this might seem like a small thing, especially because they don't specify a dollar amount or percentage on their main website, but it's not as minor as it seems. In their SEC filings, Masterworks reveals that the offering prices to members include an 11% true-up. This is basically a fee they charge for finding and financing the art deal. So, when you buy a $20 share, you're actually starting with an 11% cost right off the bat. This is something they don't clearly show on their main website, and that small note about additional expenses could mean there are other fees down the line. They even mentioned that your cash proceeds could be reduced by more fees related to marketing and selling the artwork. While in the past they might have avoided these high costs with their 11 painting track record, things might not always be that rosy. In the world of art investing, this might be a reasonable expense, but it's still pretty misleading to make it seem like their management fee and profit share are the only significant expenses when there's actually an 11% upfront fee when you join in. The real issue here isn't whether Masterworks is a good investment, but rather how they present themselves. They don't seem to be breaking any laws, and for someone who knows all the risk, cost, and potential return involved in art investing, there might be arguments for diversification and protection against inflation. Too much sponsored ads. Now, here's the thing with YouTube mentions and ads. Masterworks talks about the amazing returns of paintings they've never actually offered on their platform, and how art indices outperform when inflation is high. It's selective and doesn't make it easy to assess how art really performs as an investment. Even those index returns they show in ads, measuring performance from 1995 onwards, aren't as impressive when you look at a longer time span. There are actually other issues too. Even though the advertised shares were as low as $20, you actually need to invest a minimum of $500, which would be even higher for new members. They show price trajectory models for new offerings, and on top of all of this, they charge fees similar to hedge funds while you still have to manage your art portfolio yourself. So, while these costs and risks might make sense in the art investment world, the way they present themselves and leave out important details is quite misleading. Masterworks seem to be mainly targeting regular retail investors, not those with a lot of experience in the fine art world. Their ad focuses on everyday people who might not be familiar with SEC filings or the important details left out of the ads. It's not about targeting platforms like this, but Masterworks is a big sponsor on YouTube, and many people promote it to their followers without talking about the necessary risk and costs that need to be discussed. It's important to note that investment is suitable only for those who can afford to lose their entire investment. Okay, so maybe Masterworks does offer a genuine investment opportunity, and they might be in the right niche with the right strategy. The goal here isn't to discredit their system for identifying valuable artworks, but rather to make people think about whether the platform's returns truly represent what they should expect, and if the costs and risk are truly worth it. Fine art has been traditionally for the super wealthy because they can handle the high risk. If you don't have art expertise and are just chasing those juicy returns you see online, you should consider whether a speculative investment like this is suitable for you and your situation. If you're not careful, you might realize down the road that it's actually more than what you can handle. My hope is that people will be informed if they want to use a platform or promote it. So, that's it for the video, and thank you for watching. As always, stay financially woke.